Hello, and welcome to the Wade Borth podcast. I'm your host, Wade Borth, and in every episode, my goal is to get you to think differently about how money works and ultimately to empower you to take control of your money and your personal financing system. Let's take a look at page 12. Again, this is why it takes so many days to get through this thing, that we could spend hours on each chapter, but how the infinite banking concept got started. And this is a pretty interesting chapter as we go through it, and we're going to try to get through it in a reasonable amount of time, because what I would encourage people to do, I'm not here to tell you everything that's in the book. I want you to read it, get your own perspective, figure out where your journey starts, and then contact us, and we'll help you down through that journey. Because again, if you read it once, you understand it just a little bit more than if you never read it. And then you read it the second, third, fourth, fifth time, and it's all based on how your knowledge and understanding is growing and maturing. And then from that point, it's going to keep changing, and the meanings are going to keep changing to you because of where you're at in that journey. And it was pretty interesting because, again, in Nelson's book, he was talking about how it got started. And Nelson was a forester by trade. And it's interesting, when you used to have conversations with him, when I'd have a conversation with him, my idea of long-term really changed after I really had an understanding of what Nelson was talking about. Because, again, he was a forester by trade. So if you understand forestry, short-term thinking is 20 years. Long-term is decades and really centuries. It's not decades, but it's centuries, right? It's generations. And so when you take a different perspective, when you take that perspective of what we're doing, that's where it makes all the difference in the world. Because again, you plant this tree and it's starting to grow, and after 3 years, you got this little seedling or this little sapling that's maybe a foot tall, and you're like, man, it's 3 years worth. I want to see a lot more results. But it's the idea of planting and then planting another seedling 5 years after you've planted the first one. So it's this ongoing way to perpetuate a thought process. And that's really, really ultimately what we're trying to do, is get people to think a little bit longer term. Because we are a society of immediate results. We want to see something immediate, which I don't have a problem with immediate, but also what's your long-term plan, right?
Yeah. If you've ever actually planted and watched trees grow, and I'm laughing about this because we've done this on this property that we have. You plant the trees and they feel like they don't grow at all for a long time, and so they're spaced very far apart, and they're growing a little bit each year. And then they just hit this period of time where suddenly they go from being, like you said, 3 feet tall to being 6 feet tall, and from there they just continue to grow and get bigger. And that it is the exact same concept with these types of policies. You've got to give this time to mature and gain momentum, the root system to spread out and begin to support what's ultimately going to be a big tree.
Yeah, that's a great point. I'd never really thought of it that way, so thank you. That you have to have this root system. You can have, if you have there's probably, again, I'm not a forester. I like planting trees. I plant trees on the property we have. And so here's the frustrating part, right? So I planted some fruit trees about 4 or 5 years ago. They're just getting to the point where they're producing fruit. This year, the rabbit ate all the bark off. I had all the protection. They found a way to get in and ate all the bark off. So these trees are dead. But that's part of the issue, right? You overplant, and then we should thin, right? So we should have planted more than what we thought we needed, right? So don't go to the very bare minimum. That's actually one thing Nelson talks about, is don't be afraid to capitalize. Mm-hmm. And I look at my fruit trees now, and that's a very good point, is that they were just putting down the root system to be able to stand for the next 30 or 40 years or 50 years. I'm trying to think how long I'm going to be around or be in this place. So they're putting down this root system so they can be around for that long. That doesn't happen overnight. That takes some time. And it's frustrating because you want to see immediate results. I wanted fruit off my trees the year I planted them, but it doesn't happen. They have to put down a root system, and now we're just starting to get fruit. And if we would have overplanted versus just planting the bare minimum, losing a couple to rabbits or wrecking the tree isn't a big deal. But if you just do the bare minimum and then one fails, then we have to start over again. So that's a great point that we can touch on later. One of the things, interesting story about Nelson was he was doing what everybody, this was back in the 60s and 70s, he was doing what everybody was telling him to do, right? So this chapter is about how he got started. So he was doing what all the financial experts were telling him to do. Leverage money, leverage, buy real estate with leverage, because that's what they all told him to do. And this sounds fairly familiar right now, doesn't it?
Yeah.
Leverage as much as you possibly can. And then what happened in 1981? Interest rates went from 6 or 7% up to the low 20s, high teens, low 20s. And what happened with Nelson was he was left with about $750,000 in debt because he was doing what all the experts told him to do. Again, he was part of that conditioned thinking process. And he was left with 20% interest on $750,000. But that was back in 1980. So I want to put this in perspective. He doesn't touch on this in the book, but I've had a chance to think, what's $750,000 in today's dollars? So it's hard to think about that. But in 1980, he had $750,000 of debt. What would that be like today? That'd be like having maybe $3 million in debt today, if you figure just moderate inflation at 20%.
Yeah.
So you'd have to be coming up with $60,000 a year just to pay the interest on this note.
Yeah,
But
and that's 60,000 that he didn't expect because he was used to paying 20 or 25.
yeah, 600,000. I'm sorry, 20% of $3 million
Yeah, 3
is
million. Yeah, you're right.
600,000. So $600,000 that he has to just on interest on that note. So imagine that in today's dollars. Everybody told you go out and leverage as much as you possibly can to buy real estate, and then the Fed, somebody that we have no control over, decides, hey, we're going to go from 6% interest, which in today's terms would be about $180,000 in interest, up to $600,000 in interest, basically overnight. Where was Nelson at? He was in a really bad position because he didn't control the banking function. Somebody else did. Somebody else was pulling the levers and the strings about what the interest had to be paid, when it had to be paid back. And so that's where his clarity came from, was that those nights and days of sleepless nights and gut-wrenching days that he had to try to figure out how to make this interest payment.
Yeah, when I think about that in the context of today's economic situation, especially right now, there's lots of conversations around what's going to happen with the interest rates. Are the interest rates going to increase? Are they not going to increase? Are they going to go up and then go back down? The real bottom line of that is it was about the interest rates for him, because that catapulted him into trying to figure out another way, a better way to do this. But it isn't really about the interest rates. For him, as he realized that he had no control over any of this, it came back to that very simple concept of, I don't have any control. So whether the interest rates go up or down or stay the same is irrelevant. It is a matter of, do you have control over it or not?
And part of that is that he was caught up in the conditioned thinking of just leverage everything you can. It was Archimedes that said, give me a lever and I can move the world. And leverage sounds great as long as you're on the right side of the lever. But what happened was, and Nelson will admit it, he says in his mind, he was like, I was doing everything right. At least he thought he was doing everything right until it all turned around on him. So then he ended up on the wrong side of the lever. That's when things get ugly. So that's where he ended up. And it was in fairly quick order that it happened. It wasn't like it was this gradual thing that he can control. All of a sudden he went from leveraging himself, doing what all the experts told him to do. And in his mind, he'd been conditioned to think that he could do no wrong because he was doing exactly and he had a little success. And he could do no wrong, and he says that in his book. He says, in my mind, he says, I thought I could do no wrong. And that's what we call the arrival syndrome. And that's what he says you have to fight every day. It's like, really what you're doing is, can you learn more, or can you be in a better place tomorrow than you are today? And the arrival syndrome will have you believe that you've done everything, and you can't do any wrong. And he admits that's where he was at when he was leveraging all this property, because all the experts were pointing to him and said, you're doing exactly what we're telling you to do, and look how successful you are. Mm-hmm. There's ego that comes into play. There's all these things that think, I've done all this right, until it wasn't. Think about the people back in 2008 that leveraged properties and were buying properties with no just signature loans and all the goofy stuff that was going on. How many people had to go bankrupt, go under, because this idea of buying on leverage, and they had the arrival syndrome? Because no matter what I would tell them, when I was trying to explain this to them, no matter what I was telling them, they're like, hey, I got all this property. Obviously, I'm doing something right. They weren't looking at the banking function. They were just saying, my success has blinded me to thinking about how I can control this if things turn bad, because nobody thinks it's going to go bad until it does.
I was just thinking that right now, that we've been encouraged as a society, the whole entire country, government and all, to just take on debt, leverage, with that mindset that we're all so over leveraged. If you do actually have cash, how much of a better position that you are in. Because Wade, I'm thinking about the number of people that I talk to that take advantage of these really low interest rates, and they're borrowing from the financial institutions, and they're perfectly willing to pay them interest and just be over leveraged, and then just taking that back to this concept of, if we are the bank and we're the ones that are loaning those people the money, it's such a change in the way we think.
Yeah, and I have a saying, actually, I've done a couple of podcasts and written some articles on this too, is this is a question I'll ask my clients or I'll ask agents I'm working with, and you probably heard me ask this, right? Do you love yourself and your family more than you love Chase or Wells Fargo? And of course, everybody's going to say what?
They're going to say, of course I do.
Oh, yeah, of course I do. Seems like a silly question. It's almost insulting to some people when I ask them that question. Then I'll ask them, because here's the point, and I had a guy tell me this one time. He says, my eyesight is better than my hearing. So what he meant by that was, what I see you doing is usually better than what I hear you telling me what you're doing. So what he meant by that was, show me what you're doing versus telling me what you're doing. So then when you start looking about where are you putting your money, what are you spending your money on? Because typically what's important to people, or what they spend their money on, is what's important to people. And how they're treating their money shows you what's important to them, right? So what are you spending your money on? Do you give money to charity? Do you spend it on your family? Are you gambling? You're drinking, smoking? What's important to you? Look at people's spending habits, and you can tell you a lot about what's important to them. So when you look at and ask that question, they're going to say, of course I love my family more than I love Wells Fargo. So if you had $10,000 to go buy a car in cash, and you go buy that car, would you put that money back? A good majority of the population today would do what? They'd say,
No, I saved up the money to buy the car.
I'm not going to put it back. Why should I put back my own money? Okay, that's, again, we're going to add this up, right? So that's going to be 80% of the population. Then I would say, okay, and if you get the rare person that says, yeah, I had $10,000, I bought a car, I'm going to put $10,000 back. But you're earning 1% on that money at the bank. Again, you're not today, but let's be generous with their money. So would you pay back that $10,000 with the 1%? Of all those people that said, yeah, I'd pay that back, I'd put it back, would you pay it back at 1%?
And most people are going to say, why would I do that?
Why would I pay interest on my own money? I hear that all the time, right?
Yep.
And I'm like, okay, but if you had a loan at Wells Fargo, would you pay it back, principal and interest?
You'd have to pay it back, or they're going to come and take your car.
Right. But would you voluntarily do that because you don't want to?
You expect to do it.
You expect to do it, right?
Because you recognize that there's a value in getting money from somebody else to use for something that you...
And if you're not honest, if you don't do that, then you don't get access to that pool of money, correct?
Yep.
So if you take that same $10,000, let's say Wells Fargo's charging 5% for an auto loan, whatever they charge, maybe it's lower than that, but let's say it's 5% just for easy math. Why wouldn't you pay it back at least at 5% to yourself, to your own banking, your own family financing system? 3% of the population is going to say, yeah, I'm going to pay back at least 5%. Those are the 3% of the population will eventually control that pool of money that we talked about in the past, right? If all the money is distributed back to everybody equally, within 10 years, 97%, or 3% of the population would have 97% of the money, because they understand how the banking function works. And this is exactly the point I make. If you're willing to pay Wells Fargo 5%, and you're telling me you love your family and yourself as much as you love Wells Fargo, why wouldn't you pay yourself back, your family business back at the same 5%? Quite honestly, if you really understood what was going on, why wouldn't you pay it back at 8%?
Yeah.
And that's really what he gets at in this chapter, is that he went through this saga of doing what everybody told him to do. He had incurred a ton of debt. His world changed almost overnight on him to where he was having to pay $70,000 in interest on this money, which in today's world, again, would be about $3 million at 20%, would be $600,000 of interest. So put it in perspective. And he says there's got to be a better way. So he wanted to take control of the banking function. So if he had to pay that money back to somebody, he would want that money to be paid back to him because he was paying it to somebody else.
Yeah, I think especially in today's world where the interest rates are so low, it's so easy to lose sight of the fundamental principle here and to get caught up in what the interest rates are. So the response to you saying if you buy a car and you finance it through Wells Fargo or through Chase or whatever, and right now 2% interest or 3% interest, and then people get caught up in what the interest rate is on the policy, but they're missing the fundamental principle of it.
Yeah.
And it's
they're in the product. They're in the product. They're not in the process. Well, let's go back to what Nelson, when he originally took out these loans, he was doing what everybody told him to do, right?
Yep.
Until interest rates rose. So what happens, and I don't know what the future is going to bring for us, what happens when interest rates rise and also now it's not cheap money? That's a whole other discussion, by the way, is that all this cheap money has forced the consumer mindset to think that cash has no value.
Correct. Yes, that's a great way to put it, because that is exactly what's happening.
And so they're throwing it around like a drunken sailor on payday, right?
Yeah.
And that's an insult to drunken sailors, I understand that. But the point being that, again, we've been conditioned to think that because we don't earn anything on our money has zero value or very little value. When it's quite the opposite. Our cash, even in today's the low interest rates, have even more value. Because when things change and when the future happens, those with cash will be able to take advantage of those opportunities. Those that are leveraged are going to end up like Nelson was. Because he was doing exactly what is being preached today. Low interest rates, leverage, and then when things aren't as rosy as they are right now, then where are they going to be at? So again, it's about this idea of generational thought process. I want that tree I planted this year, 2 days ago, to bear me fruit today. But that's not going to happen. It's going to take 4 or 5, 6 years before I actually get fruit off that tree. Start thinking that longer term. When you start putting it in that perspective, then we don't care where the interest rates are at today because we know they're going to change. Where they're going to go to, I don't know. I'm guessing they're going to go up, but I can't say for sure.
Yeah. It goes back to a philosophy that I always tried to impart on my kids when they were little was if you owe somebody money, there are strings attached. I don't care if they tell you there's no strings attached or not, there are strings attached. So when you're leveraged to the bank or to a financing corporation, there are strings attached to that. Would you rather that be your string or their string? That goes back to that whole idea of freedom and control.
And think about if Nelson, eventually he got there, but think about this from our perspective. When we control the banking function, can we change the terms and conditions on our own loan?
No. When we control it, yes, we can.
Yeah, but when we don't, when we have that loan from Wells Fargo, they're knocking on your door on the first of the month saying, pay me.
Yeah.
They want to get paid. They don't care what happened. They don't care that the kid got sick. They don't care anything. They want to get paid. They want you to believe that they're there to work with you and be a friend of yours, but that's not the case because they're in there to make money. When you control that, then you have control of the terms. Now, you can't treat it as a pool of money that you're never going to pay back, but you can change the terms. Something happens. I use my example. We bought a rental property. It looked good on paper. We bought it. We had to do some renovation. We had a tenant that didn't pay the rent. Also now we have to change the terms of our loan. We use the policy to, your policy to get access to our money, and it was running through our own family financing system. So we changed the terms. We said, let's do interest only for the first year until this property gets up and running. Mm-hmm. And that was just a stroke of the pen, and it took us 10 seconds to do. And then once the property got up and we had a reserve of cash in that rental account, then we started, okay, well, let's make this payment, and we do it at 10%, and we make that payment back. Like, it all works out because we had control of that. Where, again, if it was Wells Fargo, they would say, I don't care that you don't have a tenant, pay me. I don't care that you had to do renovations, pay me. It's like the mafia. They don't care what your excuse is. They want their payment the first of the month.
Yeah.
It's the same thing.
And to add to the value that's there, if you don't pay it on time, they're also going to charge you a late fee.
Right. And here's an interesting thing. We charge ourselves late. My family financing system will charge our real estate part of our business a late fee as well. Why shouldn't we? We're willing to pay that to Wells Fargo, so why wouldn't we be willing to institute that in our own family business called the Borth Family Bank? So you have to take those things. The process that they're doing isn't all wrong. Just modern bank, we should just be taking control of those things that we can take control of. Again, we're willing to hand it over and give it over to some other organization called Wells Fargo or Chase. But if we would just truly understand what they're doing and just take the conceptual side of what they're doing, which is just access to money, putting money to work, making sure it gets paid back at a reasonable rate, and then taking access to money and putting it to work, just that whole cycle. If we just take that part of it and implement it in our lives, we're gonna be ahead of our competition, of our peers, of everybody else around us, tenfold. That was the whole, and Nelson makes that point later on in the book, is that you don't have to be perfect. You just have to get ahead of everybody else.
Yeah.
And this gets you ahead of everybody else. So anyhow, and just to finish up this chapter and to wrap it up, what Nelson was saying in the chapter was all about how he got started. And that's really where he was going with this, is that he was doing what he was being told. It worked great until it didn't, until something out of his control changed. And also now he owns a ton of money on property that is worth half or 30% of what it was a year ago. And he still owes all this money. Mm-hmm. And he has to make the payment. And he said, I don't want to ever be in that position again. I want to control that function. And that's really where he was getting at with this. And then he said, if you understand that there's this pool of money that has gatekeepers, why don't I just want to be my own gatekeeper. I'm going to own a properly structured life insurance policy with a mutual insurance company because it's ran for my benefit. And when I want access to the money, they're going to give me access to that money. And he makes the point in this chapter. He says you need to understand how dividend paying whole life works because that is the best long-term strategy that you can use. It's not the only strategy you can use, but it's the best long-term strategy. His focus as a forester was to think long-term, and it was challenging us to think long-term as well. And for some people, they don't want to do that.
And as we get to this point where we're wrapping up, you've said this, you've referenced this a couple of times, but I have this highlighted in here. And I do remember doing this when I first read this book. So this wasn't a second time go through that I highlighted it. It said the answer came back like a baseball bat across the eyes. You are standing in the midst of everything it takes to get out, but you don't see it because you look at things like everyone else. As you look at things like everyone else.
Again, it goes back to the analogy of love ourselves more than we love Wells Fargo. We've been conditioned to think that we're always going to make that payment to Wells Fargo, but when we use our own cash, we don't apply the same principles. Same thing. We've been conditioned, and you have to think about it. Who's conditioning us to think a certain way? Who has the most to gain? The banks, right? Financial institutions. You know, how many, and this goes back to people I hear say all the time, well, this is so great, how come I haven't heard about it? Because there's nobody advertising. Think about how much advertisement money banks spend and Wall Street spend to have you put your money in their control versus you controlling your own money. How many channels are on your cable system right now that talk financial conversations, right? 4 or 5, right? There's Fox Business, there's CNBC, there's Bloomberg, whatever, right? There's billions of dollars are spent to condition you to think that the only place that you should put your money is a place where somebody else controls it. Because there's an old adage, an accountant, a CPA told me this one time. He says, whoever controls the financing always wins.
Yeah.
I'm like, that's a strange statement for a CPA, but it's a true statement if you think about it. Whoever controls the financing ultimately wins, is the one that always wins.
That's kind of what the game of Monopoly was about. Whoever controlled all the real estate controlled all the money.
Right, and they eventually won.
Yep.
It was very seldom that was ever not the case.
Because if they had the money, they bought all the real estate. If they had all
Right.
the real estate, they had the money because they were charging people, so then they control all the money. It was just one thing fed the other.
Yeah, Monopoly's a great game. People should play that all the time, right?
Yeah.
Because if you understand what's going on in Monopoly, and this is one of Nelson's great quotes, if you understand what's going on, you'll know what to do. Once you figure out the rules of Monopoly, then it's very similar to what we're talking about. Control those things. You can control the banking function and be the lender, don't be the borrower. You know, be the business, don't be the consumer. And stop thinking like consumer when you're trying to run your business. That's probably the biggest thing that he got there, is that when he entered into this thought, he was a consumer. He was conditioned to think a certain way. And the only way to get out of that was to change his thought process. Standing in the middle of everything to solve all his problems is right there. He just had to start thinking a little bit differently. Thank you. That was energizing. That was exciting. I enjoy that chapter. So we'll continue the series and move down to the rest of the chapters that Nelson wrote in his book, and hopefully, Nicole, you'll continue to join me through this journey and this discussion about how we see and what we read when we read Nelson's book, Becoming Your Own Banker.
Yep, I'm really excited to continue the conversation. It's good.
Yeah, thank you.
Thank you.
If you're enjoying this podcast or know anyone else that might be interested, please be sure to hit the subscribe button and please leave a review. This will help this podcast